So there's not much difference between your CIF and CFR. Your CIF stands for cost, insurance, and freight. So what's difference actually is the insurance that you are now going to add to your cost and freight that you are giving to your prospective importer. Most of the time, the insurance is not more than $150. It's just usually about $150. So this can be done by you, it could be done by your freight agent, and it can be done by the importer himself. But to be on the safe side, most times it's actually good to tell the importer to make his own insurance arrangement for his container so as to relieve you of some stress. Or you just tell the importer during your negotiation that you stick with cost and freight, but he should take care of his own insurance. So if you add the usual $150 to the initial cost of the soybeans that we have, you see that we have $851 CIF, which is cost, insurance, and freight. So this cost is per ton. It's per ton. So let's remember that. So it's per ton, and we are actually doing it at $1.365 naira. So your cost of production of your commodity and the logistics that will move it to the loading port and the freight shipping charges and your insurance. So those are the things that are actually different in CIF. The X works is your price at that point where the commodity or the product is, like where it's harvested, where it's produced, or where that buyer or importer is coming to pick it up. And the FOB is your free on board price, which means you have to get that commodity or that container down to an agreed port where it's going to be shipped directly to the importers to the importers port of discharge. Meanwhile, your cost and freight is just the amount of money that will get it to the importer's port. So it's the best to go for as a sourcing agent is FOB, because the stress is relieved off you once the container gets to the port. But it's not like you have a lot of choice, so it's really what the importer wants. The most important thing is making sure that you build trust, you build integrity, and good business sense with the importer, so that the person can trust you and give you good export contract that you can maintain for a long period of time. So in essence, you might not have more than maybe one export contract, two export contracts. In fact, one export contract can do a whole lot for you if you know what you are doing. So if you can execute it well, get the necessary financing, meet the deadline before your contract expires. So from this payment terms, we are going to move into payment methods where we talk about letter of credit and how you can get paid, how you get your money from the importer, the negotiation strategies or tactics that they use, and also I'll be talking about some tactics that they also use when they don't want to pay you what is already on your contract. So I really want you to listen carefully to the next set of lectures, because it's very, very important for a sourcing agent.